Hello, I'm Jingjing Huang, credit product strategist. Today, we're delighted to have portfolio manager Stephen Chang joining us to discuss the latest developments in the economy and the markets and what they mean for you.
Thanks for having me, Jingjing. There's certainly plenty to discuss.
Absolutely, Stephen. Let's start with the Asia credit market. It has done very well this year, especially the high-yield bonds. One of the key Asia high-yield benchmarks has increased in value by almost 7% from the 1st of January to the start of April. What has been driving these performance?
The fundamental outlook and sentiment for high-yield names outside the property sector has noticeably improved. Asia credit spreads have tightened by about 50 basis points for the overall market and 200 basis points for high yield, outshining most global credit benchmarks. When spreads tighten, it means that the difference between what these bonds pay compared to very safe investment like government bonds has gotten smaller. This usually signals that investors feel more confident about the market, since they are willing to accept less excess return for taking on greater risk. This tightening of spreads has been a major contributor to the excess return for the Asia credit market.
But that has also led to a tighter valuation.
That is true. However, even though these bonds are more expensive now, there's another factor at play. We are not seeing as many new bonds being issued, which could imply less technical pressure for spreads to widen significantly. Another factor contributing to the outperformance of Asia credit benchmark is the shorter duration compared to global counterparts, which means they are less affected by changes in interest rates while benefiting from economic expansion. Additionally, there is an interesting pattern we have noticed in Asia. When interest rates go up, spreads tend to tighten. This trend is driven by demand from yield-seeking buyers within the region. It helps to keep the market stable and support strong performance.
So what's our outlook for the Asia credit market?
In general, we expect a more stable market ahead, given strong technicals and still low supply in the new issue market. The market's appetite for risk appears to be returning. We remain focused on maintaining a relatively more resilient portfolio and more diversified exposure towards broader Asia, while also keeping a bias for caution in the weaker sectors and flexibility, given the market isn't pricing much volatility despite geopolitical risk and election uncertainties.
So it sounds like we are navigating the Asia credit market with a more balanced approach. Shifting gears a bit, PIMCO recently shared its outlook for the global economy and the markets. Could you highlight a few key takeaways?
Yes, indeed. We recently published our latest outlook for the next 6 to 12 months, aptly titled Diverging Markets, Diversified Portfolios. We believe that the global investment landscape is set to produce more dispersed returns in the months ahead as the trajectories of major economies diverge more noticeably. While many large developed market economies are slowing, the United States has maintained its surprisingly strong momentum, with several supportive factors poised to persist. It looks like an economic soft landing remains achievable in the US, with current market pricing suggesting a low likelihood of recession. However, we think risk of both recession and renewed inflation remains magnified in the aftermath of unprecedented global shocks to supply and demand, along with varied government and central bank responses.
What about emerging markets? What's our view on the opportunities and the challenges there?
In our view, emerging market debt offers an attractive source of steady returns and diversification amid supportive global economic and monetary policy conditions. That said, there will be differentiation among the many countries in the emerging market space. We see more attractive opportunities in economies where central banks have been ahead of the curve, and for those with local rates that enjoy a real yield advantage versus those in developed markets. We believe the best way to benefit from emerging markets right now is by investing in some of these currencies.
Thank you, Stephen, for your sharing. And thank you, everyone who joined us today. Please stay tuned and join us for more updates as we try to navigate the complex markets together with you.